Welcome everyone for the first session of our channel. We are lucky enough to have a well-known personality of industry as our first guest, Mr. Rahul Singh. Mr. Rahul Singh is Chief Investment Officer Equities of Tata Asset Management. Prior to Tata, Rahul sir was managing partner with Ampersand Advisors Capital Limited. He has worked with many reputed companies like Standard Chartered Securities and Citibank Global Equities as head of research. So I have so many questions with you, sir. It's a great time for us that we are having you on our channel as a first guest. Should I start with it?
Yeah. Thank you very much. It's an honor to be your first guest and wish you all the best.
Thank you, sir. So my first question starts with, sir, how long have you been in this industry and what has been your observation with investor behavior?
So I've been in this industry for now 29 years in financial services in all. First 5 years I was on the debt side, and then after that last 24 years have been on the equity side. And I think it's been a long journey, and it has seen many ups and downs, many bull markets and many bear markets. So my basic learning from this is that market goes through cycles,
Right.
and we just have to sometimes keep calm when we are not going through good times, and not get too excited when things are going very well. That's because I've seen 2-3 big, large, deep cycles, both bull markets and bear markets on the equity side. And that's really the basic learning which I have got, hopefully which helps me going forward.
Great. So basically we understand that you have to calm at every cycle, right?
Right, on both sides.
On both the sides.
Correct. When there's panic in the market and when there is excitement
in the market. Correct, sir. My second question is, what do you think is the problem with most of the investors that they are still reluctant to allocate their money into equities?
So I think a lot of the investors today still have little bit of fear of unknown, because they have not looked at equity markets, or they are too comfortable with fixed deposits, or they're not comfortable with seeing daily fluctuations. There are various factors. There are also some set of investors who think equity markets are like equal to gambling almost, where or they have burnt money in the past, they have lost money in the past. So there are various 4 or 5 reasons where I think investors, there are still a lot of new investors which are coming into equity market. Who are still not come. So the reluctance is basically lack of awareness, fear of unknown, and to some extent comfort with stability,
Right.
even if it means lower returns. And there is a lot of adjustment required when you move from say fixed deposits or safe instruments to equities when it comes to volatility. I think a lot of people are not ready to sometimes make that adjustment, or which is not very difficult, as a lot of people have made that adjustment. But these are the reasons why people are still, I would say, sometimes still reluctant to enter equities.
Entering into equities. With this, sir, I have gone through with some data in some past few days. There are major investors, those who came after post-COVID rally. Major of that investors are new investors, right? And they haven't seen any bear cycle. What do you see that will it change something else in future market, or will this change the phase of the market? Like they will be completely wash out, or they will stay as a new generation investors?
So you're right. I think last 2-3 years the market has seen very high returns post-COVID. I think 25-30% CAGR kind of returns. So there is a tendency in the market for investors to believe that these returns have come without taking any risk.
Right.
But one should remember that any returns more than 8-10% comes with
Correct.
equal amount of risk. So they have not seen the risk side of it. Hopefully, as you go on for the next 1 to 2 years, some of that realization will come in. Some of it has already come in post, if you look at last 3-4 months market movement, I think some of that realization is already coming in. But I think it's a matter of, I would say, experience and learning. Like I was telling you, in the last 25 years, I have seen multiple cycles. There will be cycles like this in the future also. Even though the economy and the markets are looking much more robust today than they have ever looked, even then equity markets will come with risk. So what will happen is, the way to look at equities is that if you have an economy which is growing at 6-7% and you have inflation of 4-5%, so you have overall GDP growing at 10-11%,
Right.
equity can give you 12-15%. It will do faster, it will do better than the economic growth rate. That's the framework one should have in mind, that equities, when it comes to taking with moderate risk, can give you 12-15% return over a long period of time.
Okay.
In that, what happens is, suddenly you make 2-3 years extra returns. It then normalizes over the next 2-3 years.
Right.
But overall, this is the kind of return one should have in mind. And if you have that in mind and put your asset allocation right, then there should not be any major kind of adjustment required in your behavior.
Okay, thank you. The next question, I am very much excited to ask you this question. How do you apply behavioral finance while creating portfolios and managing money? And do you also feel disheartened if you miss a stock or a sector?
So, very good question. Actually, behavior finance means also that you have to keep an eye on risk. Sometimes people forget that when you're buying a stock or getting into positive territory in a particular stock, you also have to make sure that there are both positives and negatives happening in that sector. And sometimes you have to decide that what are those 1 or 2 drivers of stocks which are the most important, and whether your view on that is superior or contra to the market. Which means that you make maximum returns when you are able to take certain calls which are different from the market view, and the market comes to your view.
Right.
When the market comes around to your view, that is when you make maximum returns. When everyone has moved to that view, then it becomes a consensus view. Then that is the time to probably exit that position.
Okay.
So it's easier said than done. Obviously, it's very difficult to do, but that is the most important part of equity investing. And in that process, you cannot get everything right. You cannot say that, okay, I will get all the 10 stocks which are going up. I have to have all 10 stocks in a portfolio. It will not happen.
Right.
You have to decide where is your kind of conviction in terms of knowing that you know something, or you are taking a view on something which is better than the market view on that right now. And as I said, in that process you will miss some stocks, some ideas,
Right.
Which someone else will get, but that is part and parcel of the game. You cannot be expected to get everything which is going right in the market in your portfolio.
Correct, sir. My next question is related to the previous one. Do you apply this in your portfolio as well? And do you consult an advisor or manage your own portfolio?
So over a period of time, obviously when you started the journey, we had our own, we used advisors much more. But since I am from the industry, obviously I am also taking control of my portfolio myself, rather than being totally dependent on advisor. There is a kind of a good mix, I would say.
Right.
But over a period of time, it has moved to more do it yourself.
So can I take this that a beginner in investment should take an advisor seriously, right?
Correct, and especially someone who is not from the industry, or
yes,
understanding from the market, understanding of the markets themselves. For him, obviously, having an advisor is very important.
Important, right? How do you justify investors' expectation in terms of returns, especially after the rally post-COVID?
Right, as I was saying, there is people have forgotten that there is a risk element in when you're getting 20-25% returns. There is no free lunch.
Right.
The risks come with it. Obviously, the economy is looking good, macros are looking good, so the risks appear low, but they are always there. And therefore, what we need to do at various points of time is to take a look at your asset allocation and decide whether you are taking too much risk for your age, for your income profile, or you're taking less risk. I think that is a constant exercise which people should do. As far as the returns are concerned, like I was saying earlier also, it normalizes. If you look at not the high risk equity categories, but the lower moderate risk equity categories, 12 to 15% return, I think is still possible over a long term.
Okay.
But within that, you will have your cycles. You
Right.
will have periods of excess return, then normalizing, then excess return, then
So
normalizing.
basically, considering cycles is important.
Is
right?
an important, yeah.
I mean, time in the market is important rather than timing in the market. Correct, sir.
Correct.
So my next question is, what is your take on the growth of financial markets in India, and what supports your opinion?
So there is still a lot of financialization happening. There is still a lot of people who are opening mutual fund folios, demat accounts. So I think there is still a long way to go. A lot has happened post-COVID, like you mentioned.
Right.
So there has been a big rise in awareness, but I think financial markets growth are going to depend on the participation. As you know, mutual fund inflows have also been going up.
Right.
Direct participation is also going up.
Right.
FIIs, while they might be less positive on India today, but they are always active. They're always an active participant.
Correct.
So overall, the volumes, the participation, the number of companies which are doing IPO today, good quality companies, we are seeing so many IPOs happening in the market today, good quality IPOs happening. So that is also increasing the choice for the investors. Ultimately, for market stability and sustaining this participation, it's very important that you have good quality companies listed.
Right.
And that is still happening.
Right. So this is my next and the last question. What is your advice to the investors at large, and how they can ensure their future through distributors like us?
So I think the idea should be that they should look at what is their risk profile, their own behavior, what is their need, and then arrive at the right asset allocation for yourself, and then do it in a systematic way through SIP, STP route, rather than getting driven by performance and getting category and going into categories which is not suited to your risk profile just because there is performance of the last 2 years. Because as I mentioned, there are cycles involved. So past performance, when we say past performance, is not an indicator of future.
Correct.
We actually mean it. And therefore the asset allocation, what is right for you, you should give it serious thought. You should spend time in it and not take quick decisions based on just performance.
Past performance.
And that is where advisors can come in handy, because they have the time, even if you don't have the time.
Correct.
And they can devote that time on your behalf. I think that's the advantage of using advisors.
Correct. Thank you, sir. With this, I will end up my questions, and some key points are there which we have come out is time in the market is important rather than timing into the market. Advisors are important at a very initial stage of your investments, and with throughout all this conversation, you have completely given me a different glance towards industry, sir, and towards education regarding an investments. Thank you so much. Thank you so much, sir.
Thank you, everyone. Thank you.